Hello and welcome to Portfolio Matters, key investment lessons from 2022. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. So this is a retrospective disclaimer, which basically says any mistakes you made as a consequence of listening to us aren't our fault.
Yes.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Keith and Stuart, what do we have?
So before we get going, a quick reminder of what the economic background was going into 2022. So we had the pandemic, lockdowns, extraordinary fiscal and monetary largesse, and then lockdowns were lifted and there was a lot of pent-up demand with Western consumers with money and also a great desire to get out and spend it. So we had strong demand, and that caused high and rising inflation as strong demand met disrupted supply. Pandemic was still causing disrupted supply chains. We got a surge in inflation, which the central banks of the world were describing as transitory, and we correctly diagnosed as transient, which is quite different. And central banks were being slow to raise interest rates. And so 2022 saw them playing catch up and raising rates quickly. Now, the key events of 2022 were, first of all, the Russian invasion of Ukraine on the 24th of February. Now, that was very much against expectations. I don't think many commentators, including us, forecast that they would go against what seemed to be the political and economic best judgment and invade Ukraine, but they did. And that caused a huge spike in energy prices and fears of an energy crisis in Europe as Europe cut back its consumption of Russian gas. In the UK, we had three governments. The Truss government took over on the 6th of September after the fall of Boris Johnson. Her administration lasted longer than it otherwise would have done because on the 8th of September, we had the death of the Queen and 2 weeks of national mourning. Then on the 23rd of September, Kwasi Kwarteng, the then Chancellor, presented the mini budget, which led to huge sell-offs in sterling and a crisis of confidence in the UK gilt market. All of that caused the fall of the Truss government. And on the 25th of October, Rishi Sunak became the third British Prime Minister of 2022. So, Stuart Owen will be first to kick off with his lessons of 2022.
Right. Well, yes, a dramatic year. And the quote that brought this home to me, which I think sums up so much, is the return of gravity.
Mm-hmm.
Nassim Taleb, he of the Black Swan fame, had a tweet when he said, basically, experience in finance with a discount rate near zero is like having studied physics, except without gravity. And I think that's just sums up everything, doesn't it? The return of gravity to financial markets via a rise in interest rates from not even zero, but negative. It just threw out all the maths and the mental models that we had for how to value financial assets. And 2022 was the return of gravity. We saw that obviously in a sort of cascade affecting valuation, higher inflation leading to higher bond yields, and that affecting the price earnings ratios of stocks and the net income yields of REITs, a subject close to my heart and covered in a recent video. So basically, it was a regime shift, and I somewhat kicked myself for not properly appreciating the severity of gravity returning. And, you know, a lot of 2022 should have been predictable if we had, thought independently and adjusted our portfolios appropriately. After all, this was a famous chart that I'm showing here, which was all around the blogosphere and the internet. Interest rates were at 5,000-year lows, and it was always likely to be very important when rates moved up from such crazy levels. As I say, sort of zero or negative interest rates are just obviously going to screw up all sort of valuation measures. And we know that that played out not just in regular equity markets, but in the rise of all sorts of hopeful tech and the rise of crypto, etc. So I mean, have a look again at this chart, because I think quite a lot of what I think about 2022 is, look, the elephants were in the room and we could and should have seen them. And a reasonable amount of my positioning, I think, was defensive, but I certainly got caught out when we did shift in regimes. So another lesson from the return of gravity is that about efficient markets as well. If interest rates are zero and that pushes up the price of all sorts of assets like crypto, I mean, NFTs, I mean, what was the price of that, the first NFT that got all the publicity? It was millions of dollars, wasn't it, for the right to an internet link? But it happened. Obviously, we saw ARK, and this wasn't just NASDAQ stocks, this was all the super speculative stuff. But the absence of gravity also affected things like UK linkers, which were down at -2% real. So it wasn't just the speculative asset classes that got affected by not having any gravity around. And when gravity returned, of course, it affected all of those different asset classes, the most speculative the most. But I don't think we should forget what happened to UK linkers. So in terms of lessons, well, I think it's really that the need for patience, for discipline, to look at the elephants in the room and to trust one's own judgment without being too swayed around by the crowd. And I'm going to go on to talk about, well, look, that's looking back and trying to be wise in hindsight, but what are the elephants in the room at the moment? And have a look at the Shiller PE ratio. So this is where Shiller has taken the 10 years average earnings in the US stock market and inflated the earnings from, say, 10 years ago by subsequent 10 years inflation, 9 years ago by subsequent 9-year inflation, etc., to get a sort of steady state estimate of likely earnings performance from the US stock market and compare that to the price. Even with the fall that we saw at the back end of 2020, or most of the way through 2022 until the autumn, the Shiller PE ratio was still at basically the same level as 1929 before the stock market crash. So, for me, the one big lesson is, look facts in the face.
Actually, before you move on, Stuart, can I just chip in on NFTs? Because I thought one of the really interesting things about NFTs was, so this is a new asset class. Let's call this an asset class and be polite. And the price of it was unknown. And the way the price of NFTs was set, I thought was very interesting. And it reminded me of, do you remember the Beanie Babes?
Oh, yes, yes.
Okay, so what happened with Beanie Babes? Well, these were soft toy collectibles, which eventually reached many thousands of pounds in I think it was the 1990s. And this became an investment fad. And what happened was a housewife had been collecting these Beanie Babes, and she produced a catalogue for other collectors in which she put down what she thought would be the price. And by putting the price down on paper, it turned out the market moved to her prices because it was such it was a new market. The prices weren't transparent. And so people anchored to point of information they had, which was her prices. And so it came that she set the prices, and because the prices she quoted were quite high, that became a whole collectible market. And I think in the case of NFTs, they did a very clever thing by setting the price of these things at hundreds of thousands of dollars. They could easily have set them at, $20.
Yes, I remember a business school case study where I think some US car manufacturer was faced with competition, and he was a sports car manufacturer. So instead of redesigning the car, what they did was increase the price by 50% to imply that it was a better car. Hey-ho. So gravity and efficient markets. Well, always remember, what cash flows are you getting from these things, from crypto or NFT? That's going to help you value things. Right. So instead of just looking backwards, we'll look, what about today's elephants? Now, I was quite struck by this chart. There are many objections you can make to it, but broadly, the idea is that the green line, which is the net worth of households and non-profit organizations, shouldn't be too divorced from nominal GDP. And that was true from in the whole post-war period until about the late 90s. So as interest rates get cut, as the Fed gets put into action, you get this growing divergence between the net worth of households and nominal GDP. So one big thing that's in my mind, I'm building up on the Schiller PE observation, is that we haven't seen the full correction in US assets, even though we know the S&P is down reasonably substantially from its peak. So for me, that's an elephant in the room, that the US equities still look very expensive. And within that, the tech stuff also very expensive. And another area which I think is a complete elephant in the room that we should look at is various property markets. You've had that great chart about Amsterdam and the difference in capital values and rents in Amsterdam, but also just the very level in that chart shows that you could have a halving in Amsterdam property prices and it wouldn't bring it back to the historic levels. And I think we've got that in Australia, in Canada, in Scandinavia, arguably in the UK, but that's perhaps a bit more of a grey case. But if we're looking for elephants, then property markets. So again and again, the lesson, I think, is to trust your own analysis. You need to have the discipline of your analysis and the patience to apply it.
I couldn't agree with you more. Basically the two charts that you've shown almost together, the interest rate chart and the sort of any asset valuation chart. Obviously, all-time low interest rates, ridiculously overvalued assets, which will remain ridiculously overvalued if interest rates drop back down to where they were 2 years ago, which is what I think a lot of the market is anticipating, which is not, and in my view, not an unlikely scenario.
Yeah, absolutely. Because where I disagree with you on this chart, Stuart, is that the divergence between household net worth and nominal GDP, that is just a function of interest rates. And, if interest rates had stayed low, if interest rates are at zero, then the theoretical value of equities, becomes infinite.
Well, it's a tricky one, isn't it? Because you've got to ask, well, why are interest rates so low? And if interest rates are low because growth is low, then equities can't have it both ways. They can't have a high valuation multiple for something which isn't going to grow that much.
So I think that I agree with you, Stuart. It's very tricky. I think interest rates are low because central banks and governments between them have connived to avoid having any recession. And the only way you can avoid they've worked out you can avoid having a recession is to have quantitative easing and a very low rate of interest. And it sort of works, doesn't it, for a while? But it doesn't work forever, because ultimately you get inflation or large currency changes. One of the lessons for the last 5 years, I would say, is I have looked at what I consider to be an unsustainable situation and thought it was going to correct. And looking at these graphs, it hasn't corrected, has it? There's been a minor correction, but it hasn't corrected back to where I would always have thought it would go to, and I'm not sure that it will do.
Yeah.
Well, that is true. I also have been observing this for too long, and even at the depths of the correction last year, I was probably still out of pocket compared to having invested in the Nasdaq, for instance.
Yeah.
But it's also a question of, what can you live with? I can't really sleep at night if I'm invested in something which I think is ultimately a greater full theory investment. I need something where I fully understand, or at least I hope I understand what I've got and the margin of safety by valuation.
Yeah.
The other thing I'd say is that these misvaluations can last a very long time. And, for example, that chart of Amsterdam property prices, it has been divorced from rents for decades. And if you had bet that prices would keep on going up, even though they're incredibly overvalued, then you would have made good money. And actually using these long-term relationships to try and make short-term investments just doesn't work. Now, I completely agree with you that, Amsterdam property prices must come down as interest rates rise. But at the same time, we know property prices are very sticky and it could take a very long time.
And of course, it could happen via nominal prices, staying where they are, and inflation and any prudent saving being eroded. Yeah. Okay, so a lesson from 2022 for me, at least, is that the age-old wisdom is still relevant. For me, that means knowing your strategy and sticking with it. And for viewers of the podcast, obviously, with Keith, Richard, and me, you're actually faced with three different approaches. You've got Keith making big cyclical calls, Richard with a bias towards commodities, and me with a sort of value approach. So for all of us, we have to, I think, know our strategy. If you don't, then there's a real risk of being blown around by news flow, by price movements, by charts, by tips, by influence of friends. I mean, know your strategy. Then I think you can stick with periods of poor performance if you believe in it for the long term. Being blown around has got its costs in terms of transaction costs and in terms of capital gains taxes, etc. But I think one of the biggest costs is confusion. You don't know where you're going. So I have certainly underperformed something like the Nasdaq and the S&P 500 over the past 5 years. But I can live with that because I know what my strategy is and why I'm sticking with it for the long term. So for me, it's valuation-based investment. That for me gives the margin of safety. I love the idea of compounding income. A lot of what I invest in has got an immediate income element to it. And it also means that you can focus your research in the area that you're interested in, because there's obviously a million things you could chase down. But if you've got a definition of your strategy, then you can focus on that. So the chart here, for me, is summing up the issue that I've still got with my portfolio allocation. This is from Yardini Research, and it's one measure of valuation, the forward PE ratio. And you can see the US being much more highly valued than the rest of the world. At this data point, it was on 17.7 times forward earnings against the rest of the world on 12.4. That's the sort of thing that gets my interest and which I start chasing down.
Stuart, I'd just like to say, I think what you've said there is really, really valuable. And one of the things that over the last few years I've come to realize. So we subscribe to a magazine called, I say we, Money Week, which I'm sure many people have heard of. And I read it because it keeps me in touch with what people think are maybe sort of hot areas in the market. But every week, I reckon they have 20 or 30 recommendations, all buy recommendations. if you try and follow Money Week, you will be permanently churning your portfolio. And it's like you need to be aware of everything that's going on around you. You need to, as you say, identify a particular sector you're interested in and get good quality research in that sector. Now, your sector may change, and then it's a deliberate change of sector. You may decide that rather than being in commodities, you want to be in tech, for just for sake of argument. So then you start with doing your research in tech. But what you mustn't do is simply become a corked bottle floating in the ocean of other people's ideas.
Yeah, I completely agree. And actually, the thing I would add is that we three have all been doing this for a very long time now, and we have honed our own individual approaches, and we are confident in it. And I'd say to people who are watching who are new to investing that, it takes time. You need to find out what works for you through a process, frankly, of trial and error, and hone your own strategy and then have confidence in it and stick to it. As Stuart says, trying to switch between our three different investment approaches or anyone else's is likely to lead to unsatisfactory results.
Right. So in that context of 2022 and the regime shift, well, my big error, which I've covered in a bit more detail, was my approach to real estate investment trusts. I love the concept of masterly inactivity. I love to buy something based on its long-term value prospects, to hold it and to harvest the income. But a lesson for me is that I'm a bad seller. This could be pride. When I've done the analysis, I want to, be proved right. That's always a nightmare in markets if you want to be proved right. But maybe it was also I just liked the inactivity and just harvesting the income. But there was a massive regime change in front of my eyes, and I didn't fully think through all the consequences. I covered that in the REIT presentation a few weeks back, but in more detail, which is why I've illustrated it with Tritax Big Box here, where, here was a company that I was quite happy with, but was never going to blow the lights out. So I should have been alert when the share price had almost doubled for a stock which shouldn't be an exciting stock. I should have been alert to reconsidering what the valuation had reached. Now, I haven't applied this, but something I've been chewing over in my own mind is if there's a regime change, which there sometimes is in markets, does that mean there's a role for a trend-following ETF in one's overall portfolio as a sort of insurance against being wrong? And that if a regime changes, then a trend-following or momentum-based ETF is going to be wrong at the turning point, but is then going to protect you in the move to the new equilibrium. I've had a look around. There do seem to be some that I think they're more called commodity trading advisor ETFs. It's some sort of mechanistic momentum following strategy. So I'm going to keep thinking and looking at that.
I worry, Stuart, that is last decade's trade, because the thing is, we then had what seemed to be a permanently low inflation environment, big macroeconomic trends like globalization, and we've now shifted to one where those trends are breaking down, and we've had this big spike in inflation. And the lesson from the 70s is that inflationary episodes tend to persist. Once that the mindset of permanently low in future inflation has been broken, then you get these waves of inflation. And I worry that these momentum trades could get whipsawed. So you're constantly following the wrong trend, i.e. the last one.
Well, in which case we need an inverse ETF.
Yes.
There's always room for another financial product. Right, so turning to positioning in 2023, Keith and Richard have got their little table in the weekly. So I just thought I'd give my version of that. So where am I? Well, I think Keith and Richard are quite negative on equities, waiting for despair, and then the idea is to play the cycle and load up then. For me, I'm not so comfortable being all in, all out. So I still have a substantial equity exposure, but it's very, very heavily tilted to non-US equities, including emerging markets and even frontier markets. Now, that's very much based on valuation. I think there's a big margin of error, margin of safety. I mean, when you're buying things on 10, 11 times earnings, 5-6% dividend yield. I also think that if you've got that sort of immediate income and valuation level, you've got a bit more of an inflation hedge in that you're not invested in the long duration type stocks, which are going to be affected as discount rates rise. Aside from that, I've got a reasonable position in linkers, UK and US linkers, and I've got a chart here on the slide showing the performance of the US index-linked market, which you can see has come down substantially. And I think you can get about a 1% real yield in US tips at the moment. That strikes me as a very prudent bolt hold to be hiding out in. I've also got some smaller bets. Rethinking my REITs, I'm happy to sit with them. I think the share prices have reflected the likely downgrade in net asset values. If the operating performance of those REITs turns down in a recession, then I'll have to revisit it. But for the moment, I broadly think that the 4, 5, even 6% yields are sustainable, and in many cases are likely to nudge up over time. I've also still got an oil bet via an ETF of the US majors, but I've also got exposure to the oil and gas market via some pipeline ETFs. And there, those companies they receive a toll for transporting oil and gas. It's not to do with the oil price or the gas price. And many of those contracts have got inflation links in their revenue contracts. So those they can be yielding also about 6%, growing reasonably rapidly as the capital expenditure programs are wound down in that area. So that's my positioning, a bit different from Keith and Richard, but so I thought that would be interesting in itself. So overall, I try to maintain a quite diversified portfolio. I don't want to be all out of equities, so I'm into equities, but biased very much out of the US. And then I've got some idiosyncratic bets like REITs and oil pipelines. But for me, it's not a time to take huge risk, but I don't want to be playing Keith's cyclical positionings. I don't trust my ability to call the cycle as well as him. And I also know that I would be too incremental in changing my positions. I know myself, I'm much more likely to be averaging in. I don't have Keith's ability to admit I'm wrong, change my opinion, and move the portfolio very quickly. So for me, this is my strategy, valuation-based and much more sort of incremental position changes.
And one key takeaway from the year, Stuart?
Look at the elephants in the room.
Which in this case was the change in interest rates.
Yes, absolutely. The regime change that provoked.
Okay, thank you, Stuart. Well, now on to my key lessons, and regular viewers will know that my strategy is very different from Stuart's, and rather than having a slow and steady and sensible portfolio allocation, I try and play the cycle. So I'm either all in or I'm all out. And doing this podcast, learnt a lot last year. Now, I try and play the most volatile sectors of the market, timing the cycle. And that generally means commodities and bonds. And as regular viewers will know, during lockdown, we did a lot of analysis on small miners and oil producers. But from my interactions with people on the Discord, I have learnt a lot about investing in those companies. And so my lessons are, number one, don't believe oil explorers when they estimate their chances of success. Number two, small cap miners, and this is related, have a huge optimism bias. And they are also highly geared to the equity cycle. So the price of small cap miners really reflects investors' optimism. When they're optimistic, these things fly. The moment things calm down, get out. Number four, the world economy is very flexible, and we saw various exogenous shocks in 2022. And the asset price movements caused by those shocks just don't last, because the economics, politics, markets all adapt actually quite quickly. And regular viewers will know I've been playing the cycle, and the cycle has taken a long time to play out. And so my mistake this year is thinking that the cycle would be much faster than it has. And in doing so, I have anchored to the last cycle, which was incredibly fast. So when we think about 2020 pandemic, the markets crashed, I got in, and within 2 weeks they had bounced and were heading off to the races, and I made a lot of money very quickly. And I was expecting not the cycle to be that fast, but it to be faster than it has been. Okay, so going through those one by one. And first of all, can I thank Simon W. from our Discord for sending me a load of information on oil companies' drilling success. And this has taught me a lot. So do you remember this? This was back in January last year. We covered a small oil company called Advanced Energy, which was drilling into an old oil field that had been abandoned. And the company was saying that they knew the oil was there. The oil field had been abandoned because it had been producing for many years and simply become uneconomic when there's plenty of oil left in there. And they estimated that their chance of drilling success was between 90 and 95%. Well, the well came in dry, and the share price collapsed by 85% in a day. But, sensible thing I did, sold it absolutely immediately, and the shares continued to drift and have drifted much lower since then. Now, Simon W. then sent me a load of information on oil companies' own analysis of their drilling operations. And this is a paper which analyzed the pre-drill estimates of how much oil they would find in from 195 different Norwegian wildcat drills and what they actually found. And the bars are their pre-drill estimates of how much oil was there. The dots are what they actually found. And you'll see there are a few instances where they found more oil than they expected, but in general, they found a lot less. In fact, they tended to overestimate their chance of drilling success by a factor of 2.5.
And Keith, can I just say, it's really interesting chart. Look at the number of blobs that are on the zero line.
Yeah, I know. Yeah. Well, in case of Advanced Energy, exactly. They were claiming 90 to 95% chance of success, and it came up as zero.
What are the chances of that?
So Keith, why do you think we go for it? Is it like the lottery ticket effect that here's a chance, and a bit like people invested in tech?
Well, yes, you're hoping that if they come up, trumps, that the share price will fly. Now, I was not aware of how exaggerated the chances of success were. And the key lesson for me is to avoid exploration companies. Their chances of success are exaggerated, and actually a lot of the chance of success is already in the price. So even if they do find something, then you do get a bit of a pop, but actually is not as much as it should be. And remember, if they do find some oil, then they face a long road before getting into production, a long road in which they're going to require a lot of money. And actually, you don't want to hold these exploration companies to production, because you are going to be diluted a lot by the capital raises. And yeah, it's just not a very remunerative game. Frankly, it's much better to concentrate on oil companies with producing assets.
Sounds so like biotech, doesn't it? You can be searching around, you've got great ideas, but actually, even if your compound is effective, Glaxo is going to buy you or Pfizer is going to buy you, whatever, and that's the way it comes to market.
Yeah. And this is another analysis of wildcat oil drilling results for this 10-year period. And again, you'll see the green bars are the pre-drill estimates, and the red triangles are what actually happened. And I think you can see there's a systematic bias to be well below the bottom of the bars. So only 58% of the results fell within the P10 to P90 range. So, 80% of them should be in there. Yeah. Only 58 were, and only 6% were above. 36% were below. This is just not a very good game, frankly. And this is from BP and an analysis of their own drilling success. And they concluded that actually they're only about 45% accurate in their pre-drill estimates. So BP's analysis was there's an optimism bias throughout every stage of the drilling selection process. So people want to believe, and then once they've committed to it, they will start interpreting the data in order to move the project forward, because there's a sunk cost problem. They have a credibility problem in that they've put this forward, and then their career kind of depends on them getting these things approved. And so they'll tend to move them towards approval. So these are the summary results from various different studies showing the pre-drill success rates and how accurate they were. Summary: oil exploration companies, chance of success, halve it. But above all, actually, just don't. I have taken to avoiding exploration companies. Wait until they've actually got something, and then, actually even more than that, wait until they're actually producing something, then invest, or production is on the horizon. Number 2, small cap miners have an optimism bias, and this is very related, frankly. So we covered a few small cap miners. Rambler, Portfolio Matters problem child. We covered it when things seemed to be going well. Well, they didn't. Excelsior Mining, which shares I still own in small size. But again, it was rightly criticized as a science project. It's doing in situ acid leaching copper mining and having some problems. But, you can see here, the share price goes up on optimism, and then as the problems develop, just gradually drifts off. And I still own these shares based on the economics of the project. They're developing a fluorspar mine in Nevada, and they've actually now got funding from the American government. But frankly, the nearer the mine comes to fruition, the worse the share price gets. How does that work? And ferroalloy resources, which we've covered extensively on the podcast. Again, you have the results of the feasibility study. Share price shoots up, but then drifts off because, frankly, it's going to be years before this thing comes into production. And so when you were talking earlier, Stuart, about why do you invest in these things, you invest for that pop. But, in fact, you should get out while they try and develop the mine, which is going to take a long time and a lot of money. Reminder, this is a lesson I keep on having to relearn. The fundamental problem is everyone, investors, management, they all have an optimism bias. And
it's not quite the same thing, Keith, but I'm reminded about a Warren Buffett story where he recommends that company A is taking over company B, And of course, the investment bankers are there to explain the logic, the rationale, the financing, etc. Well, he recommends that there should be another investment banker employed to come and present the opposite case. Everyone is pushing to get the deal done, which is what you're talking about. But you need someone to be the black hat and to say, no, this ain't going to work, and here's the probabilities, and here's the costs, and here's the risks.
Yeah, absolutely.
There's a lot of optimism bias in human nature, isn't there? We tend to be optimistic, otherwise we just sort of disappear into a little room and don't come out. I think you need to be an optimist to want to run your own business and so forth. You hope it's going to work, you think it's going to work. So there is an element of that in all businesses. It may well be, however, that the mining sector or the extraction sector is very much an all or nothing. So therefore, it clarifies optimism bias versus accuracy of prediction. Whereas if you're running another type of business, it may be your profits are 100 instead of 115.
Yes, that's a very good point, Richard. You need to be super optimistic to get the funding.
And if you're wrong, the business goes bust.
Yeah, but generally the CEOs have got paid.
Yes, that's right. Yeah. And the accountants quite often.
Pause and take a look if you have not seen this chart before, because it's a really important chart if you're investing in resource companies, both oil companies and miners. The time to invest is after the discovery, after they have done the feasibility study on the mine, and when they've actually got the money and they're starting to develop the mine. That is the lowest risk time. And don't get involved back here in the, searching around for stuff. Moving on to small cap miners are highly geared to the equity cycle. And I think you can see from the charts that I showed a while ago that essentially the share price of these small caps fly on optimism. And as soon as the optimism fades, so does their share price. And on this chart, the yellow line is the S&P 500, and the blue line is the Sprott Junior Gold Miners ETF. You'll see that as the world recovered from the depths of the COVID pandemic, these small cap miners went absolutely ballistic and far outperformed the S&P 500. But then the moment the market starts to calm down, you need to get out. And when it turns down, they turn down harder. So I don't think that small cap miners should be viewed as investments themselves, but more as speculations, and speculations on playing investor psychology. Now, the fourth, and frankly, this is a lesson I should have known, but keep on forgetting, is that the global economy is incredibly flexible, and exogenous shocks do not produce lasting effects. Now, we had the Russian invasion of Ukraine and huge spike in global natural gas prices, leading to spikes in other commodity prices as well, such as coal. But they don't last, because in the case of Dutch natural gas, we had essentially Europe bidding for the global supply of LNG very successfully, to the extent that by the end of summer, European gas storage was completely full. Since then, you've seen that the price of Dutch natural gas has completely collapsed. But at the time, all the commentary was Europe is in trouble. There's going to be an energy crisis. UK is in trouble, and these prices are going to last a long time. They don't. So if you had invested in UK listed natural gas companies, you really, when that spike starts to come off, you need to get out immediately. And so this is Serica Energy. Because the other thing that happened, of course, is politicians took advantage of the high price to slap on windfall taxes, destroying the economics of these natural gas producers. So this is the share price of Serica Energy. Share price has come down pretty much by half since its peak in September. Independent Oil and Gas, well, this has done even worse because it has had some problems in its development fields. It's a small cap gas producer in the southern North Sea. And frankly, if one field doesn't work, that really starts affecting the economics. Plus, it's got lower gas prices and windfall tax. Kistos, again, share price, best part of halved. Now, the other thing that happened during the year was the Truss government's mini budget. And that really taught me a lesson, because the same thing is true for politics. So the mini budget caused this enormous sell-off in sterling and in gilts, which were totally unsustainable. And when sterling fell to 104, and regular viewers will remember I was then very bearish on sterling, I should have got out, expecting something would change. The system would self-normalize. It wouldn't get worse. I took half of it off around here. I should have taken the whole lot off on the day. And this is the price of index-linked gilts. When we had the mini budget, it caused a spike in UK interest rates, and that caused a crisis for UK pension funds who had these LDIs, which meant they had taken on leverage in the good times to try and improve their asset performance. But when things started going against them, they had to cut their leverage, and that meant selling what they could. And what they could sell was liquid UK gilts. And this is the price of the 2068 index-linked gilt. Now, on the 28th of September, it crashed to 43. Now, sadly, I was not aware of this. But if I had been, and we know somebody who was aware of this because he's an investment professional, and he doubled his money in a day. I did buy some gilts and I made a decent return, but nowhere near as much as if I'd been aware of the index-linked gilt. So sometimes in order to take advantage of these things, you have to be aware of them. And as non-professionals, we don't get that phone call telling us that things are going wrong. Number 5, and this is an ongoing lesson, is that every cycle is different and cycles take a long time to play out. And I have assumed that the rise in interest rates would cause a recession quite quickly, given the very high levels of indebtedness. And that just hasn't happened.
So can I just say, Keith, I mean, that's absolutely true. One of the things that I have learned over the last few years, actually, is that the timing of cause and effect can be hugely different to what you think it's going to be. But there's a corollary there, for example. So we are thinking, well, I don't know if we are, but the thought is that the European energy crisis is over. And my question is it really over? Or has it yet to play out in full? And we won't know that for some time. And it's very tempting. We've got a lot of news at the moment that says inflation is slowing down. Central banks are going to be able to stop raising rates, reduce interest rates shortly. But if that's the case, it's been remarkably quick. And it may be the case, but it may not be the case. And we're very inclined, I don't know whether it's these days or whether it always was, and I just wasn't aware of it, but we're very inclined as a society to look for definitive answers that resolve the question.
No, that's all true, Richard. Well, to me, what causes recession, and we've said this again and again on the weekly, is interest rates. As interest rates rise, then mortgage costs rise, the cost of housing increases and becomes so the cost of servicing your mortgage rises, sucking out demand for the economy. House prices have to come down, which reduces housing construction activity, and rising interest rates costs disincentivize capital investment. So what you get is a slowdown in construction and in manufacturing. Those sectors are the first to shed jobs, and that causes a cascading slowdown in the economy. Now, I still think that's true, but I think I was anchoring to the speed of the last cycle, and normal recessions actually take quite a long time to develop. We know that the lag between the slowdown in the construction sector and a recession can be up to 2 years. So, frankly, to my mind, we're still very much in a normal cycle. It's just that I was kind of got used to these super fast cycles, and I thought, well, I should get out and, I should immediately get into, the next trade in the cycle, whereas actually it's taken much longer to play out than I expect. But interest rates are still rising. House prices are unaffordable at these mortgage rates on both sides of the Atlantic. So I think it's only a question of time before the usual recessionary dynamics start to play out. Reminder, the Fed only began raising rates last March.
Yeah, and the usual recessionary cycle to play out would also require that central banks don't do QE.
Sorry, and your point is? Sorry, Richard?
My point is going back to this issue of asset prices and where are they going to go. So if the central banks allow the usual recessionary cycle to play out, asset prices have to fall substantially.
Yeah.
But I don't think they'll allow them to do that.
Well, the thing is, in the case of house prices, and we've I will include in the edit the chart of Dutch house prices. They have to come down. I mean, the thing is, houses prices are sticky because people don't need to sell their house generally. They can, as long as they can afford the mortgage payments, and people generally have fixed their mortgage payments for a few years. It can be a few years before higher interest rates start to cause distress. And so what you get in the housing cycle is it's a volume cycle rather than a price cycle, because prices are sticky. But high mortgage rates mean that house prices will become unaffordable, and therefore house builders will either have to cut the amount that they charge for new houses, or they have to simply go out of business.
Yeah. So reverting to Stuart's chart of various charts of overvaluation of assets, the common sense is, it comes back to the same point, the common sense is interest rates go up, we have a recession, assets revert to norm, revert to the mean of many years. I think one of the lessons of the last few years is that we cannot assume that we are now going to go back into a normal economic cycle.
I completely agree, because actually I think you have to really be following what's happening and not assume that we're going to go back to the status quo of the last 20 years. Yeah. Because we have had low energy prices for last 20 years, and we're now going into a period where, because of ESG, we have stopped investing in new oil and gas projects without cutting our addiction to oil and gas. And so I really fear that the moment that we come out of recession, that energy prices start rising quickly. And we know that when energy prices start rising, inflation starts rising, people's perception of inflation is very influenced by prices they see every day at the pump. Then they start demanding higher wages. Off you go.
That's a very good point, Keith.
Reminder of this chart that housing slows down before new orders, before profits, and finally employment at the end. Now, in this cycle, we're certainly seeing slowdown in housing and in new orders, certainly in the manufacturing sector. Profits are coming down. Employment in the US, we had the non-farm payrolls for January yesterday, actually surprised on the upside, but that is not abnormal. So I remain of the view we are in a normal economic slowdown, which is taking some time to play out. The US housing market, year-on-year sales down 30%, manufacturing orders falling quickly, and profits are also falling. And we're starting to see cuts in temporary workers in the US, although non-farm payrolls massively surprised the upside yesterday. So I just think it's only a question of time before recessionary dynamics start to bite. The equity market for now doesn't really care. That all reminds me of the great financial crisis, where, remember, the first problems with the HSBC subprime funds occurred in late 2006. And then throughout 2007, the market continued to rise. And actually, you then had a huge sell-off, essentially 18 months after the initial problems. These things can take a long time to play out. Now, I have been way too early, but on Stuart's point, I know my strategy and I'm sticking with it. And related, market timing is an incredibly difficult game and I don't always get it right. So on my strategy for 2023, no change, frankly. I'm going to be playing the cycle. I've gone too big too early, which can be quite uncomfortable, but I'm going to continue to be holding my long dated bonds. Inflation is coming down, and when the recession starts to bite, then interest rates will come down, and I think my bet will play off. But next cycle, I will be learning the lessons from this, and I will not be buying. You will not see me analyzing small spivvy oil exploration companies or junior miners which say they've found something but haven't yet developed a project. So you can hold me to that. Richard, what are your thoughts? What are your lessons for this year?
Yeah, thank you, Keith. I suppose my lesson for the year that's just gone is that I have considered that the world economy, particularly the advanced economies, are hugely unstable, and that there has to be some form of a discontinuity to reset the system. And fundamentally, that is my view. But as I see the way things evolve and have continued to evolve, your point is very, very applicable, Keith, which is these systems, they are capable of adapting hugely to exogenous shocks. And that adaptation isn't a discontinuous adaptation. So what I'm wondering is my thesis wrong that there will be a discontinuity at some point? And will the system simply slowly evolve to counter? I'm talking about the massive levels of debt.
Yeah.
Will the system simply slowly evolve and remove that problem? Or will there? And so, whereas previously I was convinced at some point there's going to be this big thing that happens and it'll all change, I'm starting to wonder whether that's not the case. And that has to affect your investment strategy. But it's not clear about how it does affect it. I mean, you're no longer, under those circumstances, you're trying to sort of parse the process by which these things will change and assume that there isn't a sudden rapid change. That's difficult, isn't it? So if you take an LDI, the pension managers would have said, this is great, we can lever up fivefold and we can get our return on gilts up by 4 times, and that covers the cash that covers our interest needs to pay current pensioners, and it's fine until the system changes and the interest, and that was a switch, wasn't it? That was a discontinuity in the market.
Yeah.
Problems. So I suppose there's a dichotomy between investing for a steady state system and investing for a system which is vulnerable to discontinuities. And it's very difficult to match those two together.
Well, I think the trouble is, Richard, that you can be waiting for a crisis forever. I think the analogy is with Japan, where and I think a lot of other people have previously thought that the Japanese debt burden is just totally unsustainable and there had to be a crisis at some stage. And there hasn't been. And, you can't invest waiting for that crisis to come. I think when it does come, you think you need to react very quickly. And so my policy would be, don't invest in anticipation of that, but be aware of it. And if it starts to occur, be very quick.
Move quickly and know what your move is going to be.
Yes.
So you don't have to work it out.
Yeah. And actually, when we talk about the debt burden, I'll be interested in your thoughts on this. There are two ways it can be resolved, in that either interest rates rise quickly and you have a crisis, and then you have to deal with the debt burden, or in the case of Japan, actually interest rates head towards zero, and in which case bonds essentially just become cash.
And the difficulty with that is everybody has to do the same thing, don't they? Fundamentally, there are two ways out, aren't there? There is either you inflate it away or you recession it away. So either your excess debt disappears through inflation, or it disappears through those holders of excess debt going bust and the debt being written off.
But in the case of Japan, Richard, it could be neither of those.
Neither, exactly. Yeah. So, and the question then, Keith, your question, I guess, is what is it that at some point does Japan actually have to do one of those two things? If debt to GDP gets to 400%, what happens? Or 600%? Is it perpetually sustainable?
The thing is, as long as people don't spend the money, in the case of Japan, then I think it is sustainable, because you're not getting inflation. And if the thing about Japan, which may not be applicable to the rest of the world, is that there's a great deal of social cohesion, as you see when them all going around cleaning up after the World Cup matches. Extraordinary.
Yes.
So if you were to say, patriotically, please don't go out and spend too much money, I think they would. Whereas, in the UK, it's like, no.
Yeah. I think the pitfall that I have to try and avoid is thinking in that these cause and effects occur quite quickly, one after the other.
Well, your investment in gold is certainly paying off so far this year. And as interest rates fall, that could do quite well.
So I think it will. I think it is, and I think it probably will, Keith. And I think also at some point I need to say, well, this investment in gold has run its course. And I'm beginning to wonder at what point that is now.
Well, that's probably the sign that it's about to happen then, isn't it, Richard?
Yes.
You must tell us when you take off your bet.
Because it'll be time for you to put it on.
Exactly, yes. Okay, I think that's it. Well, thank you all for watching. Please can you press like and subscribe to the channel. And in the meantime, it's goodbye from all of us. Goodbye.
Bye.
Goodbye. Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.